The deep dive. This is where we really try to cut through the noise, get straight to the insights that matter. Today, we're looking at a company that's, well, quietly powering a lot of the tech world. You might not know the name right off the bat, ASE Technology Holding, ticker ASX. But our mission today is to really dive deep, understand what makes this company tick out. Both its market action and its actual financial health. Think of them as like part of the hidden engine behind so much technology we use.
Exactly. And focusing on a company like ASE is, well, it's crucial right now. They're deep into semiconductor testing, advanced packaging. And with this, almost unbelievable explosion in areas like AI,
Right.
The demand for what they do, these very specific technical services, it's not just growing, it's absolutely booming. They're sort of the unsung heroes, making sure these incredibly complex chips actually work reliably. Honestly, without them, the whole AI revolution couldn't move this fast.
Okay, right. Let's unpack that then.
Yeah.
Looking at ASX's journey in the market, going way back, it tells a pretty compelling story. If you picture this, starting back in October 2000, for over 7 years, the stock was just stuck, trading sideways.
Yeah, consolidation.
Right, bouncing between $1.30 and $8,
Yeah.
a really tight range for a long time. But then around June 2008, something changed. It started trading inside this, what do analysts call it? An ascending wedge pattern.
That's it, an ascending wedge. And what's really interesting, especially when it forms over such a long time, and we're talking more than a decade here,
Yeah.
it usually signals a really strong underlying bullish trend, like a massive spring coiling up.
Right.
You see those consistent higher lows. That shows buyers kept stepping in, even as the price range got tighter. Sellers were losing steam at higher levels. It's more than just a pattern on a chart. It's, a shift in market psychology, accumulation happening.
Right, building pressure.
Exactly, building immense pressure. And then, boom, August 2021, we saw that huge breakout from the long-term range. It even dipped back, retested the wedge's lower trend line in October 2022.
Confirming the breakout.
Pretty much confirming it, yeah. And since that point, it's really respected both the upper and lower boundaries, just consistently higher highs, higher lows. That's strong action.
And fast forward to now, ASX is trading around, $10.30. And looking at the monthly chart, it's sitting nicely above the 50-day exponential moving average, the 50 EMA.
Key level.
Which, for people maybe less into the charts, that's basically a key long-term support line, right?
Yeah.
See where the average price has been. Being above it is generally bullish. But the thing that really jumps out is the April 2025 monthly candle, ultra high volume. And it got rejected right off that 50 EMA.
Oh, absolutely. That's a big one. Trading above the 50 EMA on the monthly, that alone shows significant underlying strength, kind of like a bedrock. And that rejection you mentioned on high volume, that's a powerful signal. It tells us that when the price tried to dip down to that critical average, a huge wave of buyers just flooded in. With conviction, they soaked up all the selling and pushed the price right back up. It's classic institutional buying. Reinforces that whole bullish trend we've been seeing since 21.
So the market's basically saying, nope, not going lower than this.
Kind of, yeah. Strong demand at that level.
Okay, so the long-term picture looks pretty strong. But what about right now, the shorter term? If we zoom into the weekly chart, here it looks like the stock's in a bit of a short descending channel. And it's actually testing the top line of that channel right now, which is also near a supply zone you mentioned. Seems like a key moment.
It does feel like that. That supply zone, it's roughly between $10.30 and $11.40. Historically, that's where sellers have shown up before, kind of put a lid on rallies.
So the big question is, can it break through?
Exactly. What happens if it punches through $11.40 and holds? That could be a major technical trigger. Could really unleash a strong move up. We could see it push towards that all-time high, $12.90. Or maybe even test the upper resistance of that big wedge pattern we talked about, somewhere near $13.13, $13.50.
Some $13 is often a psychological level too.
Definitely.
Right?
Big round number. Now look, markets aren't a sure thing. There's always the other side. If it fails here, breaks down through support, could it drop back? Theoretically, yes. Maybe towards $5, $5.50.
Okay.
But honestly, based on the current action, the volume, those long-term patterns, the odds strongly favor a bullish continuation. The weight of the evidence points up. Even if there's some short-term noise, it feels like it'll likely resolve upwards, given how well-positioned the company is.
Okay, so the charts show momentum. But, for a real deep dive, we got to look into the hood, right, the fundamentals.
Right.
And this is where it gets really interesting, I think. Our intrinsic value estimate for ASX is between $12.50 and $20. With the stock around $10.30 now, that suggests it could be, 20, maybe 40% undervalued just based on the numbers.
Yeah, that potential undervaluation is it's a strong sign from a fundamental view. Lots of potential upside there. Let's maybe break down some of those key metrics for you listening, the numbers that tell the real story. So the PE ratio, price to earnings, it's about 19 to 22 times right now.
Which is okay for the sector.
It's pretty much in line with the semiconductor average, yeah. But what's interesting is with this AI-driven hypergrowth, lots of similar companies trade at much higher multiples. So ASE's valuation, it seems like investors see the solid earnings, but maybe aren't baking in, irrational hype. Could mean more stable growth ahead. Then you've got the PB ratio, price to book, around 2.5 times. Seems fair, reflects the asset value without crazy speculation.
Okay.
And debt to equity, this is impressive. It's stable around 0.37 to 0.44.
That sounds low for this kind of business.
It's a very healthy range, especially in semiconductors where you need a lot of capital. Shows they're not drowning in debt while they're expanding. Good financial discipline. Their current ratio, about 1.1, shows they have enough cash basically to cover short-term bills, which is vital when you're spending big on capex.
Right, so they can invest without straining day-to-day operations.
Exactly. And lastly, the Altman Z-score, which kind of measures bankruptcy risk, is around 2.1. Not super high, but it suggests moderate financial safety. Reassuring given how cyclical tech can be.
And one more thing, for people who like income from their stocks, ASX actually pays a decent dividend. Yield is around 2.5 to 3.7%.
Yeah, that's attractive.
Definitely adds another angle beyond just the growth story.
And when you put all these ratios together, what really stands out is the overall picture. Even though they're in this high-growth, capital-hungry industry where lots of firms burn cash, ASE Technology Holding looks remarkably stable financially. Healthy balance sheet, manageable debt, enough liquidity. Even while they're making these big growth moves, it's a really solid foundation. Lets them be that reliable sort of hidden infrastructure player we talk about. It's almost counterintuitive.
Yeah.
Spending big, but staying solid.
Okay, so we've got this solid financial base. What does that actually mean for where they're heading? Let's get into the performance, the strategy fueling this.
Yeah.
They had strong Q1 2025 revenue, up about 8.1% year over year. And the key thing here, you stressed it earlier, is that this growth is overwhelmingly coming from that huge demand for AI chip testing and advanced packaging.
Absolutely crucial.
And it wasn't just top line. Net income grew 33% year over year in Q1. That's a big jump back after some softness in 2024. Shows real agility.
Yeah, and putting that in context, you just can't overstate how vital AI chip demand is for the whole semiconductor industry. Companies like ASE are right there benefiting directly. They provide those essential, super specialized services needed to get these advanced chips out the door. Without solid testing, advanced packaging, these complex AI chips just wouldn't work reliably at the scale needed.
You mentioned free cash flow is under pressure, though.
It is, yeah, because of the high capital spending, the capex. But, and this is important, that's not weakness. It's strategic. They're investing heavily now for future growth, future market share, positioning themselves for the next wave, and their long-term average free cash flow is still healthy. So these are calculated risks, taken from a strong position, not desperation.
In talking about those strategic investments, they've been really aggressive putting money into AI-related advanced packaging specifically. They're not messing around, are they? Building out capacity for what's next.
Exactly. They're building for the future. And it's backed by some really important strategic partnerships. Like think about their collaboration with AMD, for instance. Partnerships like that are critical. They drive innovation, keep ASE at the cutting edge of packaging tech, but they also lock in long-term, high-value contracts. These aren't just one-off deals. They're deep, multi-year commitments. That means stable, sticky revenue.
So beyond specific clients, how else are they future-proofing?
Well, they're also strategically expanding capacity, building out more facilities in places like Malaysia and Taiwan.
Diversifying.
Exactly. It helps de-risk things, geopolitical concerns. Diversifies their manufacturing footprint so they can meet global demand reliably, whatever happens externally. It's about resilience.
And the latest financials seem to back all this up. Strong Q1 earnings, healthy margins reported. Plus, capex in Q1 was, US $892 million, and they expect that to cross US $2 billion for the whole year. That's serious investment.
Huge numbers.
But what's really striking is they're managing this while holding NT $375 billion in unused credit lines. That's a massive safety net, or war chest.
Yeah, those unused credit lines, that just screams financial flexibility. Shows they have the liquidity to keep funding this ambitious expansion without straining themselves. And another interesting point is their customer base. It's quite stable. You noted that 44% of revenue comes from their top 5 clients.
Which could sound risky.
It could, but in this specialized world of semiconductor services, it often points to really deep, long-standing relationships. Built on trust, co-development, these clients aren't just buying off the shelf. They rely on ASE for critical services baked into their own product plans.
Yeah.
So it suggests a very stable, very sticky customer base for their advanced stuff, reinforces their role as a vital partner.
Okay, so let's try and wrap this up. Our deep dive into ASE Technology Holding, ASX. Based on everything we've looked at, the strong long-term market trends, the solid financial health, their prime position in the whole AI boom.
Yeah,
It really does look like a BUY for long-term investors, wouldn't you say?
seems that way.
Now, sure, there could be bumps in the road, near-term volatility from semiconductor cycles, that heavy spending.
Yeah.
That's always possible. But the overall story, this quiet giant, it looks exceptionally promising.
Yeah, the intrigue is really in that mix, isn't it? You've got the strong revenue growth driven by that undeniable AI demand. Then you add the solid dividends for income investors. And on top of that, a valuation that seems fair, maybe even undervalued still.
Yeah.
All those pieces together, they really support more upside for ASE. The long-term picture looks, well, pretty bullish. Highlights how crucial these hidden infrastructure companies really are.
So thinking about its strategic spot in the AI supply chain, its strong financials, how might a company like ASE Technology Holding maybe reshape how you, the listener, think about what really drives innovation and growth in tech today? And perhaps where else might you look for these often overlooked underlying enablers that are quietly powering everything? Something to think about.